Imagine treating your roof like an ATM.
Oh, yeah.
I mean, millions of homeowners do it every single year. They're turning the wood and the shingles above their heads into cash for, kitchen renovations or dream vacations, or even just paying off suffocating credit card debt.
Which is incredibly common.
Yeah, exactly. But taking that equity out of your house and just, putting it into your bank account, it's not a simple transaction.
No, not at all.
It is a fundamental rewiring of your personal financial structure.
Absolutely.
So today on the Deep Dive, we're unpacking the mechanics of home equity. We have this great source article today called 3 Questions You Must Ask Before Tapping Into Your Home Mescorrect.
It's a great read.
Yeah, it really is.
Yeah.
Because we're looking at a landscape where some homeowners are making, brilliant strategic moves to build wealth, while others are unknowingly building a trapdoor right under their own living rooms.
Yeah, it's an incredibly high-stakes environment because a home isn't just shelter. Once you build up equity, which is just the difference between what your house is worth and what you still owe on your mortgage.
Right, your equity.
Exactly. Once you have that space transforms into this massive vault of potential funding. But the foundational rule here, and the article stresses this, is that home equity is a powerful tool only if you borrow with immense purpose. And well, a crystal clear repayment plan.
Okay, let's unpack this, because if you don't have those 2 things, what are you doing?
You are essentially gambling with your shelter.
Wow.
Yeah, we aren't talking about a personal loan where a default means, your credit score takes a hit.
Right, you get a ding on your report.
Right, we are talking about the collateral being the actual roof over your head. You could lose your house.
That is heavy. So let's start with the math, because before we even get into the different ways you can extract that cash from the vault, there's a huge misconception about how much cash is actually in there.
Oh, massive misconception.
Because I know a lot of people, they look at their favorite real estate app.
Oh, yeah, checking the Zillow estimate.
Right, checking the estimate. And they see their home value went up by $100,000. And they assume they could just waltz into the bank and withdraw $100,000.
Yeah, and that's just not how the mechanism works at all. Lenders use a calculation called the loan-to-value ratio.
LTV.
Right, LTV. They are never going to let you drain 100% of the equity out of your house.
Because it's too risky for them.
Exactly. They need a buffer in case the housing market crashes.
Sure.
So most lenders are going to cap your total borrowing at around 80 to 85% of your home's appraised value.
Okay, let's put some concrete numbers to that so we can really visualize it. Let's say my home is currently appraised at $500,000.
Okay.
And I still owe $300,000 on my primary mortgage.
Right.
So in my head, I have $200,000 of equity.
Right.
I'm rich.
Right. On paper.
Right.
But the bank does the LTV math, so they take that $500,000 value, they multiply it by, say, 80%.
Okay.
Which gives them $400,000.
Right.
That $400,000 is the absolute maximum total debt they will allow to be secured by that property.
Ah, total debt.
Yes. And since you already owe $300,000 on your first mortgage, you subtract that from the $400,000 maximum.
Which leaves me with $100,000.
Exactly. You have $100,000 of accessible equity, not the $200,000 you were thinking you had.
Man. So that buffer protects the bank, but it also dictates the reality of your borrowing power.
Precisely.
Okay, so once you know that actual number, that $100,000 in our example, you have to decide exactly how you want that cash delivered. And from reading the source, this isn't just a matter of convenience, is it?
No, not at all.
How the money is delivered fundamentally changes the type of financial product you need to use.
Yeah.
Which basically dictates the structure of your debt for the next 10 to 20 years.
You're really choosing between 2 primary vehicles here.
Okay.
The first is the home equity loan, which we'll refer to as a HE loan.
HELOAN, got it.
And the second is the home equity line of credit, which everyone knows as a HELOC.
HELOC, right.
And they serve very, very different purposes. So a HE loan provides you with a lump sum of money all at once, right up front.
Okay.
And because you get it all at once, it typically comes with a fixed interest rate. So your monthly payments are completely predictable from day one.
So if I borrow $50,000, they literally hand me $50,000.
Yes.
And my repayment clock starts ticking that very same day.
Exactly. You know exactly what your bill is next month. But the ECLOC operates on a completely different mechanical logic. It is a revolving line of credit.
Like a credit card.
Exactly like a credit card, but it's backed by your house. So instead of handing you a briefcase of cash, The lender provides you with a maximum credit line amount.
Okay.
You don't take it all at once. You enter what's called a draw period, which typically lasts 5 to 10 years.
Okay. So during that window, I can take out $5,000 for a bathroom remodel. I can pay it back, then take out $10,000 for a roof repair later.
Right. It's fluid.
It's fluid. And as I repay what I owe, that credit becomes available again.
Yes.
And I'm only paying interest on the exact amount I've actively borrowed, not the whole $50,000.
Exactly.
You know, I've been trying to visualize the difference between these two products, and I keep coming back to this analogy. Taking out a HELoan is like hiring a premium caterer for a massive wedding.
Oh, I like this.
Right. You sit down, you plan the menu, you know the exact cost down to the penny, and you commit to paying for that whole package up front.
Yep.
But a HELoC, on the other hand, is like opening a tab at a bar.
Oh, man, yeah.
You don't know exactly how many drinks you're going to order over the course of the night.
Yeah.
But the bartender gives you a maximum limit, and you only pay for what you actually consume.
That analogy captures the contrast between the predictability and the flexibility perfectly.
Right.
But let's extend it a little to reflect the actual risk involved.
Okay, lay it on me.
Imagine that to open that bar tab, you had to hand the bartender the deed to your house.
Oh, geez.
And just leave it behind the register.
That makes me sweat just thinking about it.
Right. Having an open tab sounds incredibly liberating right up until the lights come on at 2 a.m. The bartender hands you the bill, and if you can't pay it, he legally earns where you sleep.
Wow. Which is the core trap. I mean, people focus entirely on the benefit of accessing the cash because it feels like a windfall.
Yeah, it feels like free money.
But the repayment structures between these two options are drastically different. With the HELoan, the repayment is straightforward. It basically acts like a second mortgage.
Yeah.
You know what you owe every month until the end of the term.
Right.
But HELoCs harbor a massive structural danger. Let's unpack the mechanics of what happens when that 10-year draw period ends. Because the way the article describes it, it sounds like a financial landmine.
It is. It's the single biggest shock to a borrower's system. It's appropriately termed payment shock.
Payment shock, okay.
Yeah. So during that 5 to 10-year draw period, while you are treating the HELoC like an open bar tab, most lenders only require you to make interest payments.
Interest only.
Right. You aren't touching the principal balance at all. So if you've drawn $50,000, your monthly payment might only be a couple $100.
Which feels incredibly manageable.
Extremely manageable.
But it creates a false sense of security, right?
Yeah.
You essentially build a decade of your household budget around this tiny, artificially low payment.
And then the draw period ends, the tab is closed.
The lights come on.
The lights come on, you can't borrow another dime, and you enter the repayment phase, and suddenly you are legally obligated to pay both the principal and the interest on the full remaining balance.
And the math compresses here, doesn't it? Because unlike a 30-year primary mortgage where you have 3 decades to slowly, chip away at the principal,
Right.
the repayment phase on an 80 LOC is often compressed into just 10 or 15 years.
That compression is exactly what drives the shock. You are taking a massive principal balance and you're forcing it through a narrow repayment window, while simultaneously adding the interest back on top. So your payment doesn't just bump up a little bit. It can easily triple overnight.
Triple.
Easily.
Okay. So if I'm listening to this right now, I'm probably thinking, well, why wouldn't I just use a 0% introductory APR credit card for these expenses instead of putting my house on the line? I mean, if the danger is this severe, why use a HELoC at all?
It really comes down to capacity and duration. A 0% credit card is fantastic for a, say, $5,000 expense that you can aggressively pay off in 12 to 18 months before the promo period ends.
Right, before the interest shoots up to 28%.
Exactly. But if you are doing a $60,000 kitchen gut job, or you're consolidating $40,000 in existing debt, you likely can't secure an unsecured credit limit that high.
Sure.
And you certainly can't pay it off in 18 months. So home equity products offer access to massive capital at interest rates that are significantly lower than unsecured debt, precisely because they are secured by the house.
Here's where it gets really interesting, though. Wait, the source mentions most HELoCs have variable interest rates.
They do.
If you have a variable rate, A&D, a sudden shift to paying principal plus interest, isn't that a recipe for disaster?
Mm-hmm.
How can a homeowner possibly plan for a worst-case scenario when the math keeps changing?
Well, if we connect this to the bigger picture, it explains why the stakes are so high. The interest you pay fluctuates based on broader macroeconomic factors.
Like a Fed.
Right. They are typically tied to the prime rate, which moves in tandem with the Federal Reserve. So let's look at the absolute worst-case scenario.
Okay.
You've been paying interest only for 9 years on a low variable rate. In year 10, your draw period ends right as the Federal Reserve aggressively hikes interest rates to fight inflation.
Oh, boy.
So you are hit with the compressed principal or repayment, and the interest applied to that principal has doubled since you originally took out the money.
The math just keeps changing under your feet.
Exactly.
And you can't budget for a moving target.
Yeah.
If you stumble and you can't make that new tripled payment, the bank forecloses. That severity means we have to look past the mechanics of the loan and examine the psychology of the borrower. I mean, why do people willingly take on this level of risk?
It's the psychological illusion of the wealth effect.
The wealth effect.
Yeah. When you watch your homeowner's value climb over a few years, you feel wealthier.
Yeah.
You look at that $100,000 of accessible equity we calculated earlier, and you think of it as your money, just sitting there being lazy.
Right.
But equity isn't cash in a bank account.
No.
It is highly illiquid value tied to fluctuating market forces. To access it, you aren't making a withdrawal. You are originating new debt.
You're borrowing against yourself.
Exactly.
And because it feels like your money, it's incredibly easy to justify questionable expenditures.
Oh, absolutely.
When we look at the most common reasons people tap into their equity, the article broadly splits them into two categories. There's risk mitigation and capital improvement on one side, and lifestyle inflation on the other.
Right. And funding a lifestyle that outpaces your income is the most dangerous path.
Right.
People use age-low-hos to buy luxury vehicles, fund elaborate weddings, or take massive vacations.
Yeah, it's very easy to sit at your kitchen table after a brutally hard year at work, look at your Zillow estimate, and say, well, I need a 2-week vacation to Europe.
I deserve it.
Right. It's about mental health, it's self-care, it's basically an emergency.
Yep.
But the financial reality of that choice is bleak because you are taking a highly appreciating asset, your home,
Yes.
and borrowing against it to purchase a completely depreciating experience. When you get back from Europe, the value of the trip is gone, but the debt remains attached to your shelter.
It's tied to your house.
Right. A vacation does not generate income to help you pay off the lien it just created on your property.
No, it doesn't. You turn a tool designed to leverage wealth into a weapon that erodes it. The math only makes sense when the return on the borrowed money outpaces the cost of the debt and the risk of the collateral.
Okay, let's transition that into practical application.
Sure.
If we evaluate those SAR purposes, capital improvement and risk mitigation, how do we match the specific financial goal to the right equity product? Let's take home renovations, which is pure capital improvement. You are putting money back into the asset, securing the loan.
Right. The product choice here depends entirely on the rhythm of the project. So if you were doing a major one-time improvement with a strictly defined budget.
Like replacing an entire roof.
Exactly. Or installing a solar array. The HELOAN is superior. You know the exact cost up front, you get the lump sum, and the fixed payments offer absolute peace of mind.
But if you're doing a phased remodel, like gutting the house room by room over 3 years.
Yeah, then the HELOC logic takes over. Because material costs fluctuate, contractor timelines get delayed.
Oh, always.
Right. With the HELOC, you only draw funds as each phase is completed. You avoid paying interest on $30,000 that's just sitting in your checking account waiting for the master bathroom demolition to start next spring.
That makes total sense. Now, moving from capital improvement to risk mitigation, we see debt consolidation as one of the most common uses. People take their high-interest, unsecured debt, like multiple credit cards at 25% APR, maybe a personal loan at 15%.
Yeah.
And they pay it all off using a home equity product at 8% or 9%.
Right.
Mathematically, trading 25% interest for 8% interest is a massive win. But functionally, if you're doing this, you absolutely want the HELOAN over the HELOC.
Oh, 100%.
Right, because the entire point of debt consolidation is to escape the absolute chaos of managing multiple revolving variable rate debts.
Exactly.
The last thing a borrower in that situation needs is to transfer their debt into another revolving variable rate product where the payment can shock them later. They need the strict discipline of a fixed HELOAN. One clear payment, one fixed interest rate, and a specific payoff date.
Yeah.
It acts as an unavoidable escape hatch from the debt cycle.
That's right. And using a HELOC for debt consolidation often backfires because of human nature.
How so?
Well, people pay off their high-interest credit cards with the ELOC, but they don't change their spending habits. So a year later, the credit cards are maxed out again, and now they have the ELOC debt on top of it, secured by their house. It just accelerates the path to bankruptcy.
Ouch. Yeah, that's a dangerous cycle.
Yeah.
But there is one use case for the ELOC that the article mentions that operates almost entirely as an insurance policy, and that's using it as an emergency fund.
Yes. It requires nuance, though, because ideally, a true emergency fund should be liquid cash sitting in a high-yield savings account. Relying on debt during a crisis isn't optimal.
Right.
However, a ELC functions as a brilliant secondary safety net because of how the draw period works. You can apply for a ELOC, get approved for a $50,000 line of credit, and pay the minimal closing costs to keep it open. Then you just let it sit dormant.
Right. You don't draw a single penny, which means you pay zero interest.
Exactly.
But if the worst case scenario happens, say a sudden job loss or a massive medical emergency, you have immediate frictionless access to liquidity. You don't have to try and convince a bank to approve a new loan while you are unemployed. The vault is already unlocked.
It's risk management. You secure the credit when your financial profile is strongest, so it's available when you are most vulnerable. But again, you must have the discipline to ignore that $50,000 sitting there during non-emergencies.
Right. You could just tap it for a jet ski.
No.
So what does this all mean? Ultimately, the utility of all these products boils down to a single, rigorous directive for anyone considering this path. Do the math up front.
Yes.
The margin for error is razor thin. You have to look objectively at your household cash flow, look at the variable rate, worst case scenarios, look at the amortization compression at the end of a draw period.
You really do. The lower interest rates are incredibly seductive, but that discount exists solely because the bank knows they can take your property if you fail. The consequences of poor planning are catastrophic.
Which brings us to the core mantra for this entire deep dive. It is not about how much you are borrowing, but how you plan to borrow.
That's the golden rule.
The mechanics of the loan matter just as much as the amount.
They really do. And as a necessary disclaimer, our analysis today is strictly for informational purposes.
Right.
Leveraging home equity involves significant risk, including the potential loss of your property. So listeners must evaluate their own individual circumstances and should always consult with a qualified independent financial advisor before executing these types of structural financial decisions.
Absolutely. Talk to a professional, run the math twice, and understand the terms. But I want to leave you with a final thought to mull over before you decide to tap into that equity.
Okay.
We've talked extensively about the dangers of variable rates and payment shocks. We've established that the bank calculates your borrowing power based on the appraised value of your home. The source warns us against treating our home equity like free money because the house is collateral. But consider this. What happens to your financial safety net if you are perfectly responsible, but the housing market dips and the value of your home drops? If your house is essentially your bank, how does your borrowing strategy change when the size of your bank can shrink without warning?
That's a scary thought.
Think about that before you open the vault. Thanks for joining us on this deep dive.